All right, welcome back, everybody, to another episode of Built to Scale. So today's guest is actually different for like the first of like 4 or 5 episodes now. That usually I've had my counterpart, one of our Brady CFO colleagues and team members, Leighton Johns, who's one of our construction centric CFOs. So yeah, I decided to actually invite on Chris Kolkhorst. That so grateful that you could join us, Chris.
Hey, thanks for having me. Happy to
Yeah.
be here.
So Chris, you lead, surety and bonding at Higginbotham. Give us a little bit more background about yourself.
Yeah, so uh man, you make me like tell my story right off the bat here, Mason.
Yeah,
So
please
native
do.
Houstonian, my dad, husband. I got 2 children, 17, 16. I used to be a baseball player, which has helped me out in life. I was able to go to Rice University and played on a good team where it hit me in left field, but our team won a national championship and we had some really good pitchers. So there were scouts in the stands and we all ended up getting drafted and played some minor league ball and thought that's what I wanted to do, but realized that was quite the grind and making $800 a month, 800, make sure you heard that. Uh, Everyone said that that's your dream to go play professional sports. And I was glad I had the opportunity, but realized maybe I should lean back on that Rice degree and see if that was worth something. And so I had a father who was had a local CPA business, small tax and audit. And if I wanted to go work for the old man, I needed more than 3 hours of accounting that I accumulated at Rice with my economics degree. And so, fortunate that had some people that had watched me play and gave me an opportunity to come join them and get in the insurance business. And it's been good. 20 something years later, I get to work with a lot of really neat companies, a lot on the construction side. So that's it. I like what I do. I like asking questions and learning, and there's always something new coming out. And goes back to college sports. So I like college sports, not really pro sports, because there's something about winning as a team. And I feel like kind of on the bonding side, I get to be part of their team and hopefully help them win.
I was interested to see. I hadn't caught the news of it, but my mom sent it to me. So I have to be careful saying this out loud, but I'm originally from California, right? And from Fresno area, and Fresno State just picked up a transfer from Rice, which is Kurt Warner's son, as quarterback. And so I was like, well, it'd be interesting that he's Kurt Warner's son. It's like, I don't know if it's interesting if he's coming from Rice, though, the football team. So we'll see.
Yeah, it's tough. It's lots changed in the college landscape, a lot of transfers, but so I think we've had a lot of quarterbacks for 1 year, then they leave, good or bad. I don't know. But yeah, good luck. Fresno was in our conference, actually. When we played, we were in the Western Athletic Conference. Now they're in something else. But yeah, conference realignment, it's crazy.
I would encourage, Netflix just came out with a new series about the SEC. Like they follow the 2024 SEC season of multiple teams. And so like they kind of go behind the scenes of LSU and Vanderbilt, and
Really?
Vanderbilt actually having a solid season and stuff, and do a lot of interviews with the players and, the behind the scenes stuff. And it's actually a really well done series. So check it out. It just came out like a week or two ago, and I think I'm on episode 3 or 4 now. So yeah, check it
I'll
out.
do that.
Yeah.
My daughter has just started her college visits, and we just got back from Nashville. We toured Vanderbilt.
Okay. Got
And
it.
if I don't know if they showed it, but they carried the goalpost down through Broadway and threw it in the river. And I now have some perspective. That's like over 3 miles.
Yeah. It's a big deal. I mean, but
Yeah.
Vanderbilt beating Alabama is also a really big deal. So
Huge. May never happen again.
yes, it was worthy of that time. So, well, great. Appreciate getting to know you. And, if I could, so I know Chris personally, and, also love, Chris is, very construction centric and focused in his work, but, Chris is also a hobby farmer too. And that's what's fun is that Brady CFO, that's kind of how we got connected to it, is reality. Somebody introduced us, and, Brady CFO serves food and ag clients as well. So it's kind of fun that you're wearing both hats really, in some way or another, personal life.
Yeah. Hopefully it's made me a little better at my job. I have huge respect for the farmers that are out there growing our food and providing and learning to operate some equipment, which didn't come natural to me. My dad was a CPA, taught me how to use a mechanical pencil and a ball and glove.
Fair
and,
enough.
but getting out there and digging in the dirt a little bit, hopefully it helps me relate to my contractors a little bit. But
Yep.
yeah.
Awesome.
But don't call me a hobby farmer because I'm applying for this USDA loan.
Okay.
And
Fair enough. Yeah.
and I'm a real farmer.
I,
I'm not
I
very
get.
good, but I'm trying.
I guess the tax definition is those whether you're making money or not,
I don't know
right?
anybody makes money farming as a new farmer.
Fair enough. Fair enough. Well, yeah, for our audience, we're going to dive in. Obviously, you know all about surety and bonding. I mean, you've been doing it for so long. And so, really, our very construction centric audience that I want to start it from the beginning. I mean, we're going to be diving deeper, but want to start from the beginning because I don't really want to make assumptions that anybody in our audience really understands bonding or surety at any level. And so I just find let's get back to the basics, right? It's like basketball. You got to learn how to tie your shoes first, right? So walk us through, Chris. Explain the idea and the concept of construction bonding for our audience.
Yeah, so it's kind of interesting. I actually wish we would call it something different because the term bond or bonding means different things to different people. And so, I mean, some people think it's like a bail bond. If you get arrested and you need to get bailed out, and then you have government bonds that are debt instruments or investment options, and you've got some guys that work on your house that say they're bonded and insured, whatever that means. I still don't know what that means, but maybe if they steal your stuff, there's some protection there. But where we come in, and as it relates to construction companies, they're called surety bonds, but it's basically providing a guarantee. And there's different ways to provide guarantees in life. I mean, the old school way is to look someone in the eye and shake their hand and tell them you're going to do what you say you're going to do. And I think that's important. But unfortunately, when you get lenders involved in contracts and different things, they want more of a guarantee. And so that's where the industry has evolved to have these surety bonds. And there's really three specific types, but two and then one that adds on, but a performance bond. So you have a performance bond, a payment bond, and then a maintenance bond. But a performance bond says that you are going to complete the work per the terms of the contract in the scheduled amount of time that it says, and it's going to be satisfactory to the owner. And so that's performance. You're going to perform the work. You're going to get it done. Then there's an aspect called a payment bond. So if you have suppliers on a job or subcontractors, so that owner wants the job to be done and they don't want any liens on the job. And so the payment bond says that everybody's going to get paid. And then usually 1 year maintenance bond comes along with that if anything that needs to be maintained or fixed. So let's get back. The bond, in simple terms, provides a guarantee that you're going to do what you say you're going to do. And there's an insurance company that stands behind that bond. And so in the event there's a default or there's a dispute and it can't be worked out, the owner can file a claim on that bond. And there's funds there to step in and help that contractor complete the work or to hire a new contractor to get it done. So kind of a long-winded answer, but think of it more, it's more like a loan than an insurance policy. So insurance policies are underwritten based on perils and actuarial tables of you're going to wreck your car at some point or there's going to be a fire. Well, on the loan side, bankers, they want to underwrite to a 0% loss ratio. They don't want any bad loans. And surety underwriters don't want any bad bonds. And so they don't want claims. And so they're trying on the front end to determine if you're worthy of that credit or not. And we can dig into that a little bit.
I think that's a great segue, right? So I'd really love to actually dig into that because I definitely view it from the perspective, and at least for our fractional CFOs in our team, that, it's funny, say for our food and ag side, we try to identify like who are actually the key, like kingdom, like, or decision makers that construction company has to pay a lot of, or that company has to pay a lot of attention to. And so say like on the food and ag side, it's usually their lender, because they really need those seasonal lines of credit in order to get them through big seasons where they may have, more commodities, more supply than they originally thought, great year, et cetera, et cetera. They're beholden to the lender and the loan covenants, that are written into their loans. Construction companies are. I would actually say, though, that the real, like gatekeeper is actually the surety representatives, right? And that is my perspective. And from what we've seen, that a lot of construction companies that do have bonding capacity, they put more weight, and it's nothing against bankers, but they put more weight, and I would honestly say rightfully so, they put more weight on ensuring that they maintain bonding capacity for the jobs that they're on, and that they can be able to ask for increased capacity for any future jobs and projects that they have in the pipeline or that they want to go bid on. And so I don't disagree with you that it is like a credit application, because I mean, obviously you're trying to make a very, very significant financial decision as a part of this. And unlike other commercial insurances where, like you said, they're statistically trying to identify, hey, how often is this loss going to occur, and do these premiums help offset, statistically, the claims that we may have. Like you said, you're really trying to make sure that nothing exists. So I'd love to dive in there. And for our audience, like sometimes we're working with clients that for the first time they're looking at getting bonding capacity, that they've worked on smaller jobs, or they've worked on a lot of remodel, but for the first time they want to go get it's not reoccurring revenue, but it's just more consistent revenue because they get longer projects that they know that they can have continuous billings on. And so they want to go work in public works or whatever the case is, and they need to go get bonded for the first time. Given what you said, that it's like making a credit decision, what should that first time, construction owner, that construction owner that for the first time is seeking bonding capacity, what should they be thinking about? How should I prepare myself for this?
I would advise all construction companies that whether you need bonding now or you may in the future, your team's important. So who you're surrounding yourself with. And so you have your internal team of your estimating crew and your financial team and your superintendents and your field labor and all that. But your external team needs to consist of a good CPA, a good banker, a good lawyer, insurance agent, bonding agent. And then with that the bond agent can then introduce you to possibly the right underwriter. So the team, like you need to have your team and interview people and figure out we're all different. Some people give communication styles and philosophy, but I would say on the bonding side, find an agent that has experience working with a similar client that does whatever that contractor's doing. And then that agent needs to have good relationships with the underwriters, because there's a little bit of negotiation on the insurance side of commercial insurance, but really on surety, these underwriters expect someone like me or the agent to do a lot of their field underwriting, to go out and meet with the contractor and assess their character and assess their capacity to do work, check references. And so that's where a good bond agent can go a long way in helping you obtain bonding by being able to meet with you and speak on your behalf. So that first bond is very important, though, because it's hard to get it. And the last thing you want to do then is mess up, because if you mess up on that first one, you're really shooting yourself in the foot. And but I would say you can get your first bond without having CPA prepared statements, but in-house needs to look pretty good. Like, there's some things that they want to, if it's written on a napkin and doesn't really add up, then they're not going to put a lot of faith in that paper, and they're likely not going to want to extend a lot of credit to you. And so, but on the first one, if it's under $1 million, a lot of times we can get somebody approved off a good credit score, and then we can verify cash or look at assets. But going forward, if you're going to need bonding, you need to get CPA prepared statements. And so you don't always have to do an audit. You can get by with a compilation or review, but as that increases, you're going to need a good CPA. But then really, it's kind of chicken or egg, right? I mean, like, how do you know if you can do $1 million job? Well, a lot of times they're going to say, because you've done $1 million job before. But it's not always that. Like, you have to be able to prove that you can do it. And so I would say references, having people to speak on your behalf, showing good team, showing good relationship with key subcontractors, suppliers, those things all add up.
It's all good stuff. That it's really interesting outside of, what you said regarding accounting, and yeah, you do want to look at, what does liquidity look like? You mentioned very qualitative things there, right? That, that, hey, the banking relationship, their team around them, what's the strength of their bench? Would subcontractors vet for them too? And so I love that, because I think, we're helping clients, that, hey, that they have never gone through a CPA review or assurance, and we're preparing their books that, we had a client that, was operating QuickBooks Online, cash basis. And they said, okay, we want to go get, some bonding. And I said, that's not going to work, on what you're operating on. Because when I ask you, how did you end last year, you don't even give me a straight answer. And then when I try to peer in and say, how did you perform on your jobs, it's even worse and more vague answer. And this isn't going to fly, right? And so, we began to help them to move to a better ERP and to switch to accrual basis. And we finally got some solid WIP reporting in place. And okay, for 2025, that's the year that we could probably get a CPA review. And for our audience, because I get questions about this all the time. So I'm just going to do a little blurb here, Chris. Chris brought up CPA assurance, and he brought up three different types: compilation, review, and audit. I think this is really important because sometimes too often I've seen business owners think that just because their CPA prepares their taxes, that is a review. And I think that the name review is terrible, because they do associate with that, like, oh, but they eyeballed my financials. Like, that's a review, right? No. So CPAs, they can go get your tax returns done. But then there's another type of service that CPA provides called assurance. So for our audience, under that assurance umbrella, there's three main layers under there, from easiest and cheapest all the way up to the most intensive and most costly. First, you start off with a compilation. It is a really light, for lack of a better word, review of your financials, where generally they identify and are looking and saying, nothing seems really materially or gravely off here, that when I poke and I look at other assets, like what kind of generally makes that up, like what's in there. And but otherwise they're not doing a whole lot more digging than that. A review is a next step up, more costly. This is a range, but for our audience, especially to get that bonding capacity for the first time, we would generally say that you should expect to probably pay $15,000 to $20,000 as a minimum for a review for a local regional CPA firm. So just kind of a thought there to prepare for. But review is a next layer up. More intensive, but not quite all the way to an audit, where we'd say for a $20 million GC or a 25, 30 million, audit might be a little bit overkill. It might be a little bit too intensive and too expensive for that business. But so if we can get away with the review, so be it. But oftentimes where we see an audit come into play is when a parent business has holdings in multiple subsidiaries, and the complexity of the financial reporting, especially bonding, needs to see it on a consolidated basis and really needs a consolidated view of everything. And so that audit really is diving a bit deeper and providing a consolidated view of everything. And at least that's from our experience. And so I hate to kind of nerd out there. We have literally gotten the question, what is a CPA review? Or, oh, I thought my tax return was the equivalent of a CPA review, so I thought it'd be good there, Chris. So sorry that I kind of stole some
That's
wind there,
great.
but yeah. So
And
yeah,
and let me
oh,
let
go
me
ahead.
jump in and say that, yeah, I mean, it really is important. I mean, the quality of your statements, which starts with having, I mean, when a contractor's just starting out, I mean, they're trying to get by and they probably don't have a full-time CFO, or maybe they have a bookkeeper. And so the better the information that you can get to the CPA to produce the statements, the better off, once I receive that, the better job I can do for that contractor.
And I think it's this, that, like, again, we had that client that when I asked him, hey, how did you land last year in terms of net income and revenues? And he legitimately couldn't give me a clear answer. And this was in March, and we were talking about the previous year, and he couldn't give me a clean answer. I just find that if you can't really speak to your financials and tell the story, I mean, you tell me, Chris, but it is one thing to have, quality internal financials, but also too, as an owner, if you go into these bonding conversations and you can't even speak to your numbers, oh crap.
Oh
You
yeah.
tell me. Yeah.
Yeah, I think I made money or so, but yes, the bonding underwriters want predictability.
Yep.
They want you to do what you say you're going to do, and I've seen guys think that they are contractors, that they need to try to impress them and say, "Oh, I'm going to make 20% on this job," and or you look at different jobs, and then the job finishes and they make 8, which is still great, but if they would have said they were going to make 8 and made 8, that'd have been better in the eyes of the underwriter.
I so appreciate you saying that, because we often are telling clients the same thing. And I appreciate you, again, you framing this like it's an ask for credit, because For a, and I would agree with you. You know, overselling and under delivering is a real problem in any case. But I think, and especially these new business owners, what got them what made them successful is their ability to get the work done, but also to sell, right? And often I have found that to sell, confidence is one of the greatest skill sets that you can have. That if you are confident, confidence sells. And I, but to that point, you know, too many business owners, I think, enter these conversations thinking it's like we're asking for an equity partner. And so we have to show them how we're going to be pie in the sky and how there's this great obtainable market. And we're going to go from, a $10 million company to a $100 million company in 2 years from now. And credit decisions, that would scare anybody making a credit decision, right? That it's whoa. You don't quite understand how much cash you're going to burn through if that's really your plan, right? And um, equity partners aren't thinking in 2 years from now, I want to get paid back. They're thinking about a long-term play. When the bank, and same type of credit decision, that bonding, agents are making is, bonding agents, how do I make sure I don't have to pay out a claim? Banks are making sure, how do you service my debt? And so if you need so much cash flow that you don't even have enough to pay back the debt, you got a problem, right? And, but I just so appreciate you framing it that way, because I think too many business owners step in these conversations and just, show like the hockey stick. And it's like, nah, that's probably not what you want to say. You want to show something more realistic here, right?
For sure. I mean, you should always be honest. I mean, that's a good philosophy in life, but you got to know your audience and when you're explaining something. And so when you're talking to these underwriters, just know most of them wake up every day and think about what could go wrong that could possibly get me fired. Right. So they want a sure bet. And so they like slow and steady and predictable.
That's the key here, and realizing too that, um, for construction businesses, you're going to have down cycles too, right? I mean, it's just the nature of the industry that, you may have a big job, and sadly, you may not have something coming in the pipeline quite as big as the last job that you had, or something may downturn, or whatever the case is. And so, um, you know, understanding that, and speaking to that it's not going to be year over year perfect growth, and just knowing that, hey, you're going to have to play it, somewhat conservative and maintain liquidity and all those things. It's just so important, right? So I just appreciate you so much framing it like it's a credit decision. And yeah, to that point, um, I just I try to tell most of our clients that, hey, when you're going asking the bank for that $1 million credit line, if you were on the outside, you know, looking in, would you give yourself $1 million credit line? And if you wouldn't, then there's probably some cleanup that you got to do, right? Very much so. So yeah, I love, you kind of had gone into, for us, the different types of bonds, available to construction companies. You've also talked about, for, a first time, say general contractor, that's looking to get bonded, what should they be looking at? I love that you said team focus, look at the team, because they may not have the track record to actually prove that they've done it. But I love that you also emphasize there that, for people that are looking to increase their capacity, they probably want to show their track record, right? I mean, they may be going for a bigger job, but still show the track record of success, that the past job that you completed that might be $5-10 million smaller, you still did it well, and you came on budget, and everything worked out, and you made good money on the job, right? So what else would you say to somebody looking to increase their capacity, that, they're in? What would you say to them that are some additional things that they should be considering?
One thing is that what surety underwriters like to see is that there's something there in the event something goes wrong, that there's a balance sheet strength or other assets off balance sheet, either personal or available liquidity, which could be a line of credit from a bank. And sometimes contractors think, oh, debt's bad. Well, I mean, too much debt's bad. Not being able to pay your debt's bad. But a letter of credit is a good thing. Line of credit, sorry, is a good thing, because underwriters see that as if something goes bad, they can go borrow on that line. And sorry, bankers, but if they can't pay back the bank and they finish the job, well, then the surety underwriter's off the hook. Uh, so that's one thing I would look into if you're, because you can get a line, you don't have to use it. but you just have it. It doesn't cost you anything. So having that conversation with the bank, uh, and then I mean, it's back to presentation. I mean, if they've worked somewhere else previously, have a good resume. Um, Talk about similar jobs. Talk about maybe relationship with this owner or this architect or something that is why you want this job, why you want to do the work. Because really, the bond underwriter, me, the banker, I mean, we don't know how to build crap, right? We have our expertise in a certain area, but it's all on this contractor to go build it. So if we approve it, it's on them to go perform. And so you just got to give that comfort level that this is a good job. Here's why it's a good job. And here's why I'm going to go complete it and get it done. And there's going to be no claims.
Yeah, I kind of reeling back just a bit, that line of credit, because we see, right? I mean, a bank's going to charge, say, like an origination fee, maybe like 1%, and even then, it's negotiable to get it. Say, if you're to get like $1 million line of credit, you pay a 1% fee on it. We try to tell our clients that's just an insurance premium. Just pay it. That would you, because the day when you need it, it's the day when you're not going to be able to get it. So get it when you're hot and you're good and you have, solid performance to show, because it is that rainy day fund. And, yeah, you don't want to use it, but I mean, I can think through a client example right now that they had a stellar 2024, absolute killer 2024. They work on a lot of federal government jobs. And so you can imagine back in March, once Doge came out, and started doing, its handiwork, some of the departments that they started working with, even though there was no word that Doge actually came after those departments, it felt like federal funds generally got put on a freeze. I mean, every department was just kind of skittish, like, whoa, are our budgets about to just be slashed here? So we need to be careful about what projects we start so that we don't have projects, middle of construction here that all of a sudden our budget's cut and we don't know what to do. And so they're feeling so some of their jobs that they were expecting to take off aren't quite taken off or haven't quite taken off. And now they're taking off. But, if they didn't have that credit line, and we actually asked for a credit line increase, if they didn't have it, they were carrying a bit of overhead as if, they were still performing like they were at the end of 2024, which is really solid. And they didn't want to let team members go because it's so difficult to find some of those overhead, types of employees that, a lot of companies, they direct expense like their project managers, but still, like, if you don't have the work, like, it's an overhead expense. Like, you don't pay your project managers usually hourly. They're salaried employees that their expense is there even if they don't have work to work on, right? And to go manage. But they have critical team members that they weren't ready to let go. And thank the Lord that they did have that credit line, because it allowed some pivot room for that day when they needed it. And now we've paid it down and it's all good. But yeah, I say this because I've also been in conversations with business owners that they say, why would I carry the expense, or why would I have the expense of a credit line if I really don't need it? And it's like the credit line is for the day when you do need it, and you don't need it right now. And that's when you're supposed to get it. It's an insurance premium. Just pay it. Just pay the $10,000 for the $1 million credit line, and you're gonna, say your graces and or your thank yous when the day that you actually do need it. And so yeah, I just like
Or
to
you don't,
emphasize that
or
point.
you don't need it. And
Yeah,
it allows you to get that $2 million job or $5 million job that you make a good profit on. And
yeah,
so more than the 10,000 it costs you. So
yeah, yeah. I mean, it's like you said, like it could give you that excess liquidity to get the bonding, to get the job. And so, sometimes you got to pay to play, right? And that's the thing of this, is you have to understand, like, it's a pay to play, and that, new revenue does cost something. And if you think it comes out of nowhere, you're not operating in the real world, right? So, love this. You know, what would you say that you want to see in project contracts to give you assurance to offer the highest potential bonding capacity? Like, or maybe even a different way that we could frame it is like, what are the things that scare the living crap out of you when you look at a project contract?
yeah, I mean, you want to be fair in simple terms. So you want it to be, it's called the AIA contract. It's a kind of a standard out there, but you like to see that liquidated damages are reasonable. The amount of days to complete the job, reasonable. And a lot of the times you're gonna back to we're not building anything, so we're relying on the contractor to tell us, hey, why do you think you can complete this job in 60 days or 100 days? But those are things. But something that's come up recently, and this is important. So COVID changed things, and so force majeure language. It's French. I think it means act of God. But we've started to recommend that contractors include that in their contracts. And then more recently with the tariffs, we're also recommend, again, not an attorney, but as their bonding agent. Um, it's called change of law clause. And so a tariff change, it's called a, look it up, change of law, that you can put it in there about in the same section with force majeure. And that gives a little extra security if something changes out of their control.
Yeah, the tariffs is a huge discussion right now, right? That so many companies are just buying it, like just taking it on the chin with the tariffs right now, and they didn't include that language, but for sure with any future contracts and estimations, you have to at this point. Yep.
The other thing I didn't mention, payment terms, very important, right? We want our guys to be able to get paid in a reasonable amount of time. Hopefully they get paid before they have to pay their suppliers, but realize sometimes there's can't. But we just want it to be reasonable.
So yeah, Chris, I'd love to walk through with you because I find that it's we can talk about these high level terms, but actually having some real concrete examples is just really wonderful for our audience to really get a grasp on. Maybe they see themselves in some of these examples. Like we have legitimately seen these examples, and so that's why that's where these questions come from. And so we know that there's not only one out there that's experiencing this. So we'd love to kind of walk through some case studies and some scenarios with you that say a general contractor, they have some current liquidity issues. The project owners decide to put a pause on moving forward past the design phase. So this is a design build, contractor. They put a pause on moving forward past the design phase of the project, and the contractor's carrying some fixed overhead of project managers, superintendents, et cetera. Again, even though I know most contractors stick those expenses in direct job expenses, the reality is you still got to pay a salary, right? And you may be allocating their 40-hour a week salary across multiple jobs wherever they spent their time, but you still got a fixed overhead cost regardless. And this particular contractor, they have not carried long-term debt. They just don't have a lot of it. They have a credit line, but they're facing some liquidity issues to the point that they need some injection somewhere in there. They need some, they need some bolstering of cash. They could take their vehicles and go refinance them and, put some long-term debt on their vehicles collateralize them, or they could take a draw on the credit line, and use some of their credit line capacity. From a bonding perspective, does it really even matter which direction they choose to you, or would you potentially give some recommendations of one choice versus the other? What would you say in these circumstances?
Great question. So from a bonding standpoint, the underwriters are going to put a lot of emphasis on working capital. Okay. And so usually your aggregate bonding capacity is going to be a multiple of working capital. So sometimes they use technical language like it's a 5% case. Okay. That really means 20 times your working capital. So if you have $1 million of working capital, you can go get $20 million of bonded work at one time. Okay. So current assets minus current liabilities equals working capital. So line of credit, even though sometimes the term may be 18 months, underwriters on the bonding standpoint count that all as current. So if you tap the line of credit, that is going to hurt working capital. If you refinance vehicles and you push that debt out, only the first 12 months of that is going to be considered current. And so it won't affect your ratio as much. So I'd say in that example, it makes more sense, if you can, to have long-term debt versus short-term.
Yep, makes sense. Yeah. And the struggle too is, right, if you have the line of credit, you probably have secured it with the terms and everything else. But if all of a sudden, and this is kind of my advice out there too, that you draw on that line of credit by the time that you try to go make a decision to refinance your vehicles, they're going to look at your total debt load, and it's actually may scare them about financing those vehicles. Granted, they have an asset to secure, but it's easier to go secure an asset without a big debt load already than it is if you didn't have the debt load. And then if absolute worst case comes after you've done the refi, you still got the line to work with. So you still even got more pivot room to work with. But yeah, no, I appreciate that. Yeah, and for our audience, I hate to make any assumptions. Chris mentioned their current assets minus current liabilities equals net working capital, and current assets being pretty much all your very liquid assets. That the things that there's accounting definitions that I don't even agree with the real accounting definitions in some of this, but basically, if you own real estate or you own equipment and vehicles and stuff, general accounting terms say that that's not highly liquid. And even though hey, if you put your vehicle on the street with a for sale sign, you might be able to liquidate in a week faster than some of your AR. I get it. It's basically equipment and real estate is not liquid. Generally, everything else is considered current assets. If I could put it into layman's terms, and then current liabilities being everything you owe in the next 365 days. So all of your subcontractor bills, any other vendor payments, credit card payments, any accrued payroll. So people have worked for you, but you haven't fully paid them yet based upon your payroll cycle. Any due bonuses, as well as for long-term debt, whatever is due in the next 12 months on that debt. So principal and interest. So the idea is you take all those current assets, all of your more liquid assets, minus those current liabilities, that's your net working capital. And you want to maximize that number from what I'm understanding, Chris, that as best as possible, you want to maximize that number because that's kind of your, for lack of a better word, your very short-term, oh crap, fun,
Right.
if I can say it, right? Yeah.
Shows your ability to withstand and make your obligations over the next year.
Yep.
And some cushion. Yeah.
Yep. Yep. Okay, great. I would love to walk through a couple more case studies here, scenarios. So this is one that we see a lot. A lot of general contractors, they have their primary business, their general contracting business. They've gotten off the ground. It's operating well. Ultimately, it turns into their cash cow. Their dream is actually to become a real estate developer. They work for a lot of real estate developers or work alongside of them. They actually want to go start doing some small projects themselves that they see that world and that's what they want to be in. And they're passionate about building something and selling it and trying to get the deal done, right? It's kind of a deal maker capacity, a mentality. And also too, we've seen a lot of our clients that, leveraging that, hey, they have a skill set that I could probably get a better rate of return on my time and money than I could if I just stuck in the stock market, if I went and did development myself. But we have a lot of clients that they're GCs, they do some development projects on the side. In order to do that, they usually have to pull liquidity out of the business in order to do that, right? They got to pull some funds out that they can start that project. And even though they may be able to get outside financing for that project too, that generally they're pulling some funds out and pulling out liquidity out of their primary business. What would you advise to some of those clients to make sure that they're not putting themselves in a bad situation that could potentially damage their bonding capacity?
Yeah. This is a good one. I get this one a lot too. And it's gotta be careful how you word it because most business owners, that's their baby and don't tell them how to run their company. And that's fine, except if you need bonding capacity or surety credit to operate your business and to continue to get work and to perform work. And so back to my example before, every dollar you take out of cash, that's $20 of bonding capacity that you don't have. If you have excess working capital, that's fine. Or if you don't need it, but we can't always have our cake and eat it too, right? There's trade-offs. And so you just got to balance that.
I find one of the biggest things for any of our audience that, is scaling their business, net profit is not necessarily a measure of how much distributions you can take out of your business. And that's one of the big things that we want to see. And if we could put it on a platform and tell the world is net profit is not a measure of cash flow because there's a lot of, you could be making payments to go buy vehicles and equipment in cash. You could be making debt payments and the principal portion of those debt payments and the cash capex or the cash expenditures on vehicles and equipment, none of that shows up on your P&L. And so just be really cautious about how much money you are pulling out of your business. That you gotta maintain that balance sheet, right? So final little case study or question here, because again, these are all things that we see very often, and sounds like you do too. So good, we're talking the same language, and I'm sure many of our audience have probably experienced the same thing. But contractors tend to run a lot of personal expenses, and it's not just contractors. Most business owners out there do. I mean, heck, whatever I can legally run through my own business as Brady CFO, I'm going to do it. Again, legal is the key word there. But intent is, you want to reduce taxable income and therefore reduce the amount that you have to pay the IRS. And so, you want to try to run as many expenses through the business, but, what can be a challenge is, you're not showing great income then. You're not showing that you're really making much money. What would you tell, clients that are really just driving their income down to the floor, if anything, with just loading those personal expenses in, that from a bonding standpoint, how is that going to look to you? And are there ways that, if they do that, because this is a nuanced one. If they do this, they tend to keep more cash in the business because they've lowered their tax bill. Granted, they're paying for it on personal expenses, but them doing a lot of tax management does keep, does keep some liquidity in the business and not going out to the IRS. But yeah, what would you say to this? What would you prefer to see this company do, or what advice would you give them?
Yeah, no, this one's great. This one happens all the time, especially end of the year and people asking questions. And it's similar to the last answer. You got to know your audience. You got to know, look in the future what you may need. And so I'm with you. I hate paying taxes. I told you, my old man's a CPA, and he tells me when I complain about my taxes, boy, that's a good problem to have. That means you made some money. And I said, yeah, but I don't feel good about giving my hard-earned money to the government so they can go waste it. If your business requires surety bonds and you need those, then underwriters do like to see profit. And we can have a conversation. And if there's a story to be told, hey, we're trying to minimize some tax. We did a few things into the year. There's some things happening now with that big, beautiful bill with some bonus depreciation, different things. But generally speaking, it gets back to your team. It gets back to open communication. If you have the right team member, the right surety agent, the right in-house CFO, CPA, you can be honest with those people, right? We're not the IRS. We're all working together to try to accomplish the same thing. And so I'll just say, be mindful and have those conversations before you do something. If you know that come first quarter, there's a really big job you want to go after that's going to need to be bonded, then you need to take that into consideration, that financial statement needs to look good.
I just appreciate, throughout this episode, Chris, you put some emphasis on, the team, integrity, character of the people, and decisions being made around that. And, just having an honest conversation. And I guess I just want to encourage to our audience that, yeah, revealing your finances to somebody feels like you're taking off your clothes, right? Especially, again, there's so many entrepreneurs that we come across, and construction business owners that, they're touting their projects, they're touting their top line revenue, but then when you look at the bottom line, it's, well, like, there's a different story to be told. And from practical experience, I found that the companies that seem to have the most money spent on PR are the ones not really making money. But to that point, we know that it could be frustrating, or that you feel like you should have the answers, or you feel like you should have something to show that's better than what you have. It's okay. Be honest with it. The worst thing that, in a credit discussion, the worst thing I feel like you can do is try to hide something, that you've destroyed trust at that point. And that's the whole point. Like, it's a credit decision. It's they are making a decision as to whether they can trust that you will actually complete that job and you will pay all of your vendors and your subcontractors, et cetera. It's a trust decision. So if they figure out that you lied to them, trust is broken. Yeah, not a good thing, right? So I just appreciate your emphasis on that. And if anything, I just want to encourage that, for those first time GCs going out and trying to get bonding, that, be honest, it's okay. Most business owners are going to have a blip on the radar that they're going to have, they're going to have a story to tell that not everything was perfect until you got to that point. It's okay. I'm sure, Chris, you've seen it all in 20 plus years, of what you've been doing. So it's okay. So I just appreciate your emphasis on that.
Yeah, thank you. Yeah, I couldn't agree more. I mean, who hadn't made a mistake? All right. I mean, that's just being honest. Contra, if you had a bad job that you lost money, tell them what you learned and why you're not going to do that again. Because that gives them, you're showing that you're real, that you've took your lumps and you're still standing and you're going to be better next time.
Yep. Yep. Yeah. I loved it. So many banks, their compliance teams will look back at the past 3 years and make a credit decision. They'll say, you had a loss year and, 2 years ago. So we can't get ourselves wrapped around this. We can't offer you credit. And I loved it. I talked with one banker and he said, well, the fact that they had a terrible year and then they came back the next year showed me that they know how to pull themselves out of the ground. And isn't that what we really want? And yeah, so it's okay, just be honest. But yeah, Chris, we're kind of coming to up on time here, but I so appreciate you having you on here. That just appreciate your very practical, salt to the earth approach to these types of things, and just viewpoint that, hey, it's like asking for credit. Be open, honest, build yourself a good team around you of both internal team members, advisors, and basically understand your audience, right, of who you're asking for things. And it's a credit oriented, decision, and therefore it's a credit oriented audience, and craft your message in that way. So I just so appreciate having you on. Anything else you want to leave our audience with?
No, that was it. Just thanks. I'm a fan of the show, and so good to be on. If I can help anybody, happy to. If not a fit for everybody, but find yourself to put together the best team you can, and then go out there and work hard. And I mean, you're in business. You're living the American dream, and so it's just been a pleasure. Thanks for having me.
Yeah, for our audience, yeah, it's fall. It's fall's coming up here. That I'm sure that you're going to be harvesting some corn here pretty soon, right? That did you plant any this year?
Well, so we are more we plant in the spring,
Okay,
uh, but I'm gonna plant a fall garden. So
okay, got it.
we're doing some planning right now. So
Okay,
we
pumpkin,
just got a
squash, and
new,
all that.
yeah, probably gonna go heavy on the cabbage.
Okay,
I feel
got
like
it.
that's the cabbage doesn't get the credit it deserves. I think that is a good vegetable.
That's the Texas salad, right? Coleslaw, like
Uh,
good to go. Cool, awesome. Thank you, Chris. Yeah. Until next time, but appreciate having you on. Really
yeah,
appreciate you.
man. Thank you.
Yep. Thanks. Hi, everyone. So if you enjoyed today's episode and you found value, or it raised some questions for you about the next best steps for managing your finances in your construction business, please reach out to us at bradycfo.com. There's a contact page there where you can fill out, and that will come straight over to us. Either that, or you can personally find me on LinkedIn. My name is Mason Brady, and feel free to send me a message, and happy to chat and talk through anything you're facing today, and happy to provide some advice. So thank you all. Appreciate it. See you.